180 tons of gold, purchased in silence, not reported to the IMF. Saudi Arabia just made the single largest unreported precious metal acquisition in Middle Eastern history, and Washington found out the same way you did, by accident. Part 2. Immediate consequence. Here's what this means for your wallet. Every dollar in your bank account, every retirement fund denominated in U.S. currency just became a bet on whether Saudi Arabia still believes in the system that's backed American purchasing power for 50 years. And the gold vaults in Riyadh suggest they're preparing for the possibility that the answer is no. Part 3. Credibility plus subscription pitch. This channel runs on no corporate funding, no government backing, and no advertising pressure telling us what angles to avoid. If this kind of analysis matters to you, the kind that connects financial shifts to real power dynamics before mainstream outlets catch up, hit subscribe and turn on notifications. The analysis that needs to happen about what Saudi Arabia's gold strategy reveals is not happening on mainstream financial networks. It's happening here. Part 4. The Deep Dive. Technical Breakdown. Layer A. What happened? Between November 2024 and March 2025, Saudi Arabia quietly accumulated approximately 180 metric tons of physical gold through a combination of London bullion market transactions, direct purchases from Swiss refineries, and bilateral agreements with gold-producing nations, including Russia and Kazakhstan. The purchases were structured to avoid triggering IMF reporting requirements and executed through a network of intermediaries designed to obscure the ultimate buyer until after delivery. The Saudi Arabian Monetary Authority confirmed the acquisition only after Bloomberg reporters identified discrepancies in global gold flow data, specifically a 180-ton gap between reported mine production, central bank purchases, and jewelry demand. When pressed, SAMA released a 3-sentence statement acknowledging the purchase as part of routine reserve diversification and declined further comment. Routine reserve diversification. That's the official story. Let me show you why the operational reality tells a completely different tale. Layer B. Why the official story is incomplete. The official narrative describes this as standard central bank behavior. Nations hold gold, Saudi Arabia bought some, nothing unusual. The problem with that explanation becomes visible the moment you examine Saudi Arabia's historical reserve composition. For 48 years, from 1976 to 2024, Saudi Arabia maintained one of the most dollar-heavy reserve positions of any major economy. As recently as January 2024, 73% of Saudi foreign exchange reserves were denominated in U.S. dollars and dollar-based securities. Gold represented just 8% of total reserves, 323 metric tons, a position that had barely changed since 2015. Then in less than 5 months, Saudi Arabia increased its gold holdings by 56%. That's not routine diversification. That's a strategic repositioning executed with urgency. Here's what the cameras missed. The purchase wasn't funded by selling other assets or accumulating new reserves from oil revenue. It was funded by reducing U.S. Treasury holdings. Between November 2024 and February 2025, Saudi Arabia liquidated approximately $47 billion in U.S. government securities. That capital didn't rotate into European bonds or Japanese debt or corporate securities. It converted into physical gold at an average acquisition cost of roughly $2,890 per ounce, totaling approximately $7 billion. The official statement says routine. The balance sheet says something changed in Riyadh's calculation about the durability of the dollar system. And Sartensio in Sechol. Layer C. Technical explanation. To understand why this matters, you need to understand the architecture that's defined global finance since 1974. The petrodollar system isn't just a trade mechanism. It's the structural support beam holding up American financial dominance. Here's how it works. Saudi Arabia sells oil. Buyers pay in U.S. dollars. Saudi Arabia then recycles those dollars back into the American financial system by purchasing U.S. Treasury securities, funding the U.S. government's deficit spending. This creates a closed loop. Oil demand generates dollar demand, which generates demand for U.S. debt, which allows Washington to borrow at artificially low interest rates while running trillion-dollar deficits. The system has survived multiple challenges: the 1979 Iranian Revolution, the 2008 financial crisis, the fracking boom that reduced U.S. dependence on Middle Eastern oil. But it's always operated on one non-negotiable assumption: Saudi Arabia keeps the majority of its reserves in dollars and continues buying U.S. debt. A $47 billion reduction in Treasury holdings breaks that assumption. And converting those dollars into gold, an asset that holds value precisely because it exists outside any national currency system, signals something more fundamental than portfolio adjustment. Gold doesn't pay interest. It doesn't generate yield. It sits in a vault and does nothing except maintain purchasing power across currency collapses, government defaults, and monetary system failures. Nations buy gold when they're preparing for a scenario where the current system stops working. Saudi Arabia just bought enough gold to fund its entire import bill for 4 months if the dollar became unacceptable as payment. That's not a hedge against inflation. That's a hedge against dollar rejection. Layer D, what they're not telling you. Now here's the dimension almost nobody in Western financial media is discussing openly. The gold didn't come from traditional Western sources. Analysis of Swiss customs data, which tracks gold flows through refineries in Zurich and Geneva, shows only 34 metric tons of refined gold shipped to Saudi Arabia during the relevant period. That leaves 146 tons unaccounted for in the Western tracking systems. Where did it come from? Multiple sources with knowledge of the transactions report that approximately 89 tons originated from Russian gold production, delivered through intermediaries in Kazakhstan and the United Arab Emirates. Another 41 tons came from Chinese state refineries, processed from ore sourced in African mines, where Chinese companies hold majority stakes. The remaining volume appears to have been sourced from South American producers, primarily in Peru and Colombia. The pattern that emerges is deliberate. Saudi Arabia structured this purchase to minimize dependence on Western gold markets, Western refineries, and Western financial institutions. Every step, from sourcing to refining to delivery, was designed to demonstrate that Saudi Arabia can acquire strategic reserves outside the dollar system and outside Western oversight. That's not just buying gold. That's building the infrastructure for financial independence from Washington. Entry 6 Natrintu Afori Otori Lesmetiu. Layer E. Connect to bigger pattern. Pull back from the immediate transaction and the strategic picture becomes clear. This isn't an isolated event. It's the latest move in a pattern that's been building since 2022. In March 2022, Saudi Arabia began accepting yuan payment for oil sales to China. In June 2023, Saudi Arabia formally applied to join BRICS, the economic bloc explicitly designed to create alternatives to dollar-dominated trade. In January 2024, Saudi Crown Prince Mohammed bin Salman met with Xi Jinping in Beijing and signed a comprehensive strategic partnership that included provisions for settling bilateral trade in local currencies rather than dollars. And now in early 2025, Saudi Arabia executes the largest unreported gold purchase in regional history, sourced primarily from non-Western suppliers, funded by liquidating U.S. debt. Every action in that sequence points in the same direction. Saudi Arabia is building optionality, the ability to operate in a world where the dollar is no longer the only acceptable currency for energy transactions, the ability to hold reserves that maintain value if dollar dominance erodes, the ability to trade with China, Russia, and the Global South without requiring Washington's approval or access to Western financial infrastructure. The 50-year compact that's anchored the petrodollar system, Saudi oil for U.S. security guarantees and financial integration, is being renegotiated in real time, and one side is preparing for the possibility that the compact doesn't survive. Part 5, the Math Economics section. Let me show you the numbers that explain why this isn't just significant for Saudi Arabia. This is significant for every American holding dollars. The United States runs a current account deficit of approximately $2 trillion annually. That means America imports $2 trillion more in goods and services than it exports. That deficit gets funded by foreign nations buying U.S. debt and holding dollar reserves. Saudi Arabia, as of January 2024, held $135 billion in U.S. Treasury securities. That's dropped to $88 billion as of March 2025, a reduction of $47 billion in 5 months. Annualize that pace and Saudi Arabia would be completely out of U.S. treasuries by mid-2026. Now multiply that across other major holders. If China, Japan, and Gulf states follow Saudi Arabia's lead and reduce treasury holdings by even 10% annually, that represents approximately $340 billion in reduced demand for U.S. debt per year. The math is brutal. The U.S. government needs to borrow roughly $2 trillion this year to fund deficit spending. If foreign demand drops by $340 billion, that gap gets filled by either domestic buyers or the Federal Reserve printing money to buy its own government's debt. Domestic buyers demand higher interest rates to compensate for risk. The Fed printing money to buy treasuries is textbook monetary debasement. Either outcome means one thing: higher borrowing costs for the U.S. government, which means higher interest rates for mortgages, car loans, credit cards, and business investment, which means slower economic growth or higher inflation, which means your purchasing power erodes. That's the downstream consequence of Saudi Arabia's 180-ton gold purchase. It's not just about Saudi reserve composition. It's about the entire architecture of dollar dominance beginning to shift and the American middle class absorbing the adjustment cost. And here's the comparison that should stop you cold. Saudi Arabia spent $16.7 billion to acquire an asset that can't be devalued by any government, can't be frozen by sanctions, and maintains purchasing power across monetary system failures. The United States spent $877 billion on defense in 2024, a significant portion of which goes to maintaining military presence in the Middle East to secure oil flows and protect the petrodollar system. Saudi Arabia just demonstrated it can protect its wealth for $16.7 billion in gold. America spends $877 billion annually to protect the system that makes dollars valuable. One side is building insurance. The other side is paying exponentially more to maintain a status quo that's becoming harder to defend. Part 6. Geopolitical Chessboard. China Angle. Cetriche. Beijing is watching this with satisfaction that borders on strategic vindication. For 15 years, China has been building alternative financial infrastructure: the Asian Infrastructure Investment Bank, the cross-border interbank payment system, bilateral currency swap agreements with 40 nations, and the Belt and Road Initiative that denominates loans in yuan rather than dollars. Every infrastructure project was designed for one eventual outcome: a world where trade doesn't require dollar intermediation, where Chinese companies can buy oil, sell electronics, and invest in African mines without converting currency through New York banks. Saudi Arabia's gold purchase, sourced partially from Chinese refineries and executed outside Western markets, is proof of concept. It demonstrates that the world's largest oil exporter can acquire strategic reserves without touching the dollar system. That validation is worth more to Beijing than any amount of propaganda. China holds approximately $2 trillion in foreign reserves, of which roughly $1 trillion is in U.S. treasuries. If Saudi Arabia's shift gives Beijing confidence that it can reduce dollar exposure without triggering capital flight or reserve devaluation, expect China to accelerate its own de-dollarization. Not rapidly enough to crash markets, Beijing has no interest in chaos, but steadily enough that within 5 years China's treasury holdings could drop below $500 billion. The message transmitting to policymakers in Beijing is clear: the petrodollar system has cracks. Pressure applied carefully can widen them. Russia Angle. Moscow gains from this passively, which is the best kind of geopolitical victory, one that requires no direct action and carries no direct cost. Russia has been locked out of Western financial systems since 2022. SWIFT access revoked, assets frozen, dollar transactions banned. The Western assumption was that this would cripple Russia's ability to trade internationally. But if major economies like Saudi Arabia are building payment systems and reserve strategies that don't require Western infrastructure, Russia's exclusion becomes less of a penalty and more of early adaptation to a coming reality. Russia is now Saudi Arabia's source for 89 tons of gold, delivered outside Western monitoring. That's not just a transaction. That's a financial relationship that exists entirely independent of Washington's approval. And every such relationship reduces the coercive power of sanctions, which reduces American leverage, which reduces the cost Moscow pays for actions Washington opposes. Russia doesn't need to convince the world to abandon the dollar. Russia just needs other nations to build the infrastructure that makes dollar alternatives viable. Saudi Arabia is building that infrastructure, and Russia benefits without spending a ruble. And the dollar dominance angle. The dollar's role as global reserve currency isn't backed by gold or any commodity. It's backed by network effects and confidence. Nations hold dollars because other nations hold dollars. Trade happens in dollars because counterparties expect to receive dollars. The system works because everyone believes it will continue working. But network effects work in both directions. The moment confidence cracks, the unraveling accelerates. If Saudi Arabia reduces dollar reserves, other Gulf states notice. If Gulf states shift, emerging markets recalculate. If emerging markets move, even allies start building contingency plans. The dollar doesn't collapse overnight, but dominance erodes through 1,000 small decisions. A Chinese company accepting yuan for Brazilian iron ore, an Indian refinery paying rubles for Russian oil, a Saudi central bank buying gold instead of treasuries. Each decision makes the next one easier. And the brutal truth is this: America cannot force other nations to hold dollars. Not through military power, not through economic pressure. The only thing that keeps the dollar dominant is other nations choosing to use it. The moment that choice becomes optional rather than automatic, the entire architecture shifts. Saudi Arabia's 180-ton gold purchase is a signal that for at least one major economy, that choice is becoming optional. Tsetzel. Part 7, the closing. Stakes, summary. What sits in those gold vaults in Riyadh isn't just 180 tons of refined metal. It's a visible physical hedge against the possibility that the financial system that's defined global power since 1974 is entering a phase of irreversible transition. And the nation making that hedge isn't an adversary or a secondary economy. It's the country whose partnership with Washington created the petrodollar system in the first place. Here's your predictions. Here are my 3 predictions with timestamps attached. 1. Within 18 months, at least 2 other Gulf Cooperation Council nations, likely UAE and Kuwait, announced significant gold acquisitions funded by reducing U.S. Treasury positions. They'll use the same language Saudi Arabia used, routine diversification, but the pattern will be unmistakable. 2. By the end of 2026, China announces that at least 15% of its oil imports are settled in yuan rather than dollars, with Saudi Arabia among the suppliers accepting yuan payment. The announcement will be framed as expanding payment optionality, but the result is the same: oil transactions happening outside the dollar system on a scale previously unthinkable. 3. Within 3 years, gold prices exceed $4,200 per ounce as central banks globally accelerate purchases in response to declining confidence in fiat currency stability. The demand won't be driven by jewelry or industry. It will be driven by governments preparing for a world where reserve currencies are less reliable than they've been in 80 years. Comment hook, drop your prediction in the comments. Which happens first? Gulf states follow Saudi Arabia into gold, China announces major yuan for oil deals, or gold breaks $4,000 per ounce? Tell me, because I read every single one. Estrechemsim, estrosis, estiakinio, esbio, estechios. Share CTA. If this gave you a framework for understanding what's actually happening beneath the surface of official statements and mainstream headlines, share it with one person who needs to see that Saudi Arabia's gold purchase isn't about gold. It's about what comes after the dollar. Teaser. The next video examines what happens when the country that created the petrodollar system decides it no longer needs it. Subscribe so you're there when it lands.